What's up, everybody? Today we're going to be talking about the foreign exchange market or the FX market, and we're going to be covering what it is, what the players are, and why it matters, and how it's influenced by the different macroeconomic forces. So to start with, the FX market is the largest asset market out there in the world and the most liquid one. It's its valuation is, or the volume is $7.5 trillion, way larger than any other market out there. I mean, compared to the New York Stock Exchange, the Tokyo Exchange, the London Exchange, I mean, these differences are extreme. And it is also, like I mentioned, the most liquid market. So you can trade there 24/7, and you're gonna get filled. So somebody's gonna buy or sell your euros or your dollars, and there are these main pairs that people trade. And these are the Euro USD, USD GBP, AUD USD, USD CHF. And essentially, the value of these currencies is derived from the value of the other currencies in which they're paired with. So essentially, if we go to Euro USD, this is how many USDs fit in 1 euro. And in this case, it's essentially 1.11. When the euro dollar goes up, it means that there's strength in the euro relative to the dollar. And when the euro dollar goes down, it means there's weakness in the euro relative to the dollar. And this essentially is a representation of two currencies, the euro and the dollar, matched in a graphical form. And currencies become increase in value or decrease in value against each other throughout the day and throughout the years. And this is kind of what it looks like for the euro dollar. And I want to show you what the DXY is, which is a widely used metric to kind of get a gauge on the strength of the dollar. The DXY it's an index that has a basket of currencies that trade against the dollar. So it's the dollar paired against a variety of currencies, and essentially it's a good measure of dollar strength. So most recently we can see that the dollar has been getting weaker and weaker and weaker as interest rates are inching lower in the US. The Federal Reserve recently decreased interest rates by 50 basis points. And when interest rates are higher in a country, usually the currency strengthens because people move their money from that country from a country of low interest rates to a country of high interest rates to gain more interest. So a good example of that has been the USD MXN, which is the dollar peso, Mexican peso. And recently, the peso has slightly been inching lower, or there's been more dollar strength than peso strength. But over the past couple of months, we've seen a tremendous strength in the Mexican peso because there's a higher interest rate in the Mexican central bank than there is in the U.S. So a lot of people borrow dollars in a lower interest rate and go and set them in U.S. in pesos in Mexico and make money off the difference of interest rates or in the interest rate differential. Another reason why the peso has been strengthening has been due to trade flows, where essentially the flow of currencies between one country and another. And in this case, there's been a lot of nearshoring from the U.S. to Mexico. Essentially, that this means that a lot of manufacturing companies have been moving to Mexico to lower the cost of manufacturing, and then eventually they ship it to the rest of the world. This has been another secular trend, strengthening the peso and obviously affecting the FX market. And so going back to other examples, we get this is GBP USD, or essentially the pound against the dollar. And I'm going to show you an interesting thing that happened in 2016, which is the Brexit. And I will show you how this is it. And I will show you how the British pound fell against the dollar significantly in one day. And this is what happened. This is the Brexit right here. And we can see it fell around 9% in a single day. I remember it was at night. I remember shorting the British pound against the dollar, and everybody was in awe just looking at this situation, which was not expected, where the British pound or the British exited the European Union and essentially got rid of the euro. And ever since, the pound has kind of been ranging in between this average between 1.43 and 1.19, and it's kind of been in this range, in this lull. And this kind of exemplifies how the macroeconomics of countries really affect currencies. And these, there's a lot of participants in these markets. There's banks that ensure that perhaps one company sells, let's say, I'm going to give you an example. I'm Volkswagen and I sold $10 billion worth of cars this year, and now I want to get them back to the eurozone. I want to get them back to Germany, and so I can pay employees and other costs. Usually, I have to go through a bank to do that, and a lot of these banks are in charge of doing that. So that's one participant. Another participant are speculators. These could be hedge funds, traders, retail traders. I used to be one of them, where essentially you're betting on the appreciation or depreciation of a currency against another. So another example of market participants are its algorithms. There's a lot of algorithms already in the market that are also trading for hedge funds and liquidity providers, or essentially these funds that make markets and try to make money by selling currencies to these traders. So there's a ton of participants out there in the market, and and this is essentially, these are some of the rates of the some currency rates. And here we have Euro USD, USD JPY, and it's always changing. This market's always moving. It's extremely liquid. And another thing is the bid-ask spread. So the bid-ask spread essentially difference between the price I'm going to buy and the price I'm going to sell. The ask price is the price in which I'm going to buy the pair. So the asking price is this. I'm going to buy, if I want to buy your USD, I'm going to do it. I'm going to go with this price. If I want to sell, I'm going to go with this price. And usually people trade in pips, or essentially it's the third and fourth decimal of the rate. A slight movement, a 0.05% movement, is significant for us traders because it is usually leverage trade. So usually you're trading, when traders are involved in the FX market, they're using leverage. And here we can see how there is dollar weakness, because the euro appreciated against the dollar here. The yen in this case, there's strength. There's yen strength here, and here there is pound strength because the pound appreciating against the dollar. And here we can see from the Canadian, so the Canadian dollar has appreciated against the dollar. That's why USD CAD has declined. That there's different metrics people use to try to get a gauge of the market. Like I mentioned, there's GDP, there's interest rates, and let me show you, for instance, also macroeconomic indicators that impact the FX market. And usually, for instance, different headlines like the inflation rate of Japan is going to definitely impact the USD JPY rate, and depending on what the consensus is, there's going to be a movement there. And here these stars kind of measure the impact of the headline on the pair, and we can see how the France job seekers total for August is going to be a higher impact on the euro than, let's say, some other piece of news like this one from Switzerland. And we have all these different economic indicators: crude oil inventories, crude oil imports, industrial production year over year, and this is for Russia, 5-year note auction, and there's different there's different macroeconomic indicators and headlines that we can use to get a gauge on what the FX market is going to do in a specific pair. So we look at let's say the currency we're interested in, USD JPY, and then we go and take a look at what are the latest announcements to try to trade or profit from that volatility. And here we have the central bank rates. As I mentioned, usually I hire, there's some times where there's this thing called a carry trade, where essentially people grab a loan, or essentially ask for money in a low interest rate economy. Let's say people get a loan from Japan or have a leverage trade from Japan, and then they put that money in, let's say, the US. So they make money off the interest rate differential and they gain interest every day based on that differential. And if the opposite happens, if you're being financed with a higher interest rate currency and you're purchasing a lower interest rate currency, you're going to pay usually for that interest rate differential. And that's one of the trades that people use. Another thing to mention is that the FX market trades almost 24/7, as I mentioned. Usually the periods of most volatility is between 4 a.m. to 9 a.m. EST, and this is kind of like the overlap between the London and the New York Open, because these currency markets open in different parts of the world and there's some overlaps, and as you can see here, these overlaps are the most active hours. The overlap between the London and the New York trading hours are the ones with the most overlap. There's also an overlap between the Sydney and Tokyo Open, and these are usually areas where traders want to focus on for kind of gaining some volatility and making money. So that is the FX market in a nutshell. If you have any other questions, don't forget to ask them in the comments below, and feel free to subscribe and like to get more videos like this in the future. Thank you.